Here to discuss Silicon Valley real estate market, the week number 21. What you're looking at is the sale price to list price distribution for each week. The purple line out here is the most recent week. The burnt orange line is the previous week. What you're seeing here basically are the oldest lines, the dotted lines, followed by the dashed lines, and then the solid lines. So the market was down about where it is now, maybe a little bit better. Then it drastically improved, and now it's turned around and it's come back down. And by drastically improved, it's sort of hard to really put this in words. It drastically improved, not that it improved that much, but it went up to record high levels. The best week we ever had was just back on March the 26th. So even though that's significantly better than where we are now, when you look at the range way down here, because this is the worst week we ever had, you can still see we're doing very well. It's hard to express that we're doing very well, although we're not doing nearly as well as we were doing just 2 months ago. But that's basically what this data is showing. This is the pressure the buyers feel. How much are buyers willing to overbid? And you can see it really is sagging at the upper end. So buyers aren't feeling the pressure to go much more than about 20-25% above the asking price, where just a few weeks ago, they were paying 35-40% above the asking price with no problem. It's also interesting to look at the slide down here. When it's on the axis, the 100% line, you're getting exactly the sale price. So you can see the number of offers that got accepted below asking prices significantly. The number of offers selling at asking price has gone up. And then finally, where it takes off the axis has moved. Some of the dotted lines you can see were further over, and that's probably because we were coming out of a slower marketplace, so buyers weren't so used to it. But anyway, that's what the data shows. This is the same data, just only for 12 weeks, so it's easier to see. Same concept. The dotted lines are the oldest lines, which were basically the month of March. The dashed lines are next oldest, which are basically the month of April. And then the solid lines are May. And you can see that the trend has been definitely down. This is May 7th, this orange line up here, or yellow line. The gray line is May 14th. The burnt orange line is May 21st. And then the purple line is May 28th. You can see that you've been progressing down each of the last 4 weeks. This is just a quote I showed last week from the Mercury News on the 19th. Low inventory and high demand fuels the robust Silicon Valley marketplace. Well, let's look at the demand side. The broad blue line is the current demand. So you can see the best year we ever had was 2021. Why was that? Well, we were coming out of the pandemic. So this is the pandemic here. So all these transactions that didn't happen in 2020 are now going to happen in 2021. So 2021 came out and basically broke all the records. 2022 was right behind it up until right about this point. And you could even argue up until here. So let's go the latter time frame. So right at the end of March, we were doing the second best year. Then boom, you come down here at the beginning of April, and all of a sudden you're the fourth best, tied for the fifth best year, or fourth best, depending on how you want to do it. And then you went up, statistical fluctuation, then you're back down. But now pay attention, the only year we're outperforming, with one exception, is the pandemic year. So when you're sheltered in place, you're down here on the gray line in 2020, but now in 2022, you're the next year, and this is based on offers accepted, basically tied here for all intents and purposes, but then again, significantly below. For those that have been following me for a real long time, know that I historically, back in the 90s, 2000, believed that the sales volume was a strong indicator of what the future of the market's going to be. And it is actually a very strong indicator. So even though the market is still robust by a lot of measures, the fact that we're having the lowest number of transactions out of 8 years, except for the pandemic, is pretty significant. Now we're looking at the blue line, which is the available inventory. That's the other side of the equation. You can see just a few weeks ago, week 17, we were down here at only 80% of the inventory you'd expect. Now we're probably up here at about 105% of the inventory you'd expect. That's a pretty significant increase in number of listings that are available. So the availability has gone way up. At the same time, the demand has gone way down. That's a recipe for lightening up of pressure on pricing, which is why the sale price to list price ratio is what you saw, which is basically dropping. Then the number of new listings, the big spike is a little unusual, except remember, we're basically Memorial Day weekend this weekend, and it's falling on the 30th. It can fall as early as the 25th of May, which would have been in the previous week. If the 5 years that I'm using as a benchmark, 15 through 19, had an earlier Memorial Day like they did, then the fact that Memorial Day is later, last week we had more normal inventory because it wasn't impacted by the holidays. So that explains the big spike up. And if you look at it, you're basically at 100%. We had this huge dip down, and I spent some time researching it, and it's sort of bizarre. Out of the sort of 8 marketplaces that I've now expanded into, which are the 4 counties, Alameda County, Contra Costa County, San Mateo County, and Santa Clara County, condos and townhouses, the only one that was really impacted was Santa Clara County single family homes, but that's the biggest single market out of those 8. So it had an impact on the overall data. And I have no idea why it happened. It's the only market out of the 8 that was impacted, and it was impacted pretty significantly, but it rebounded. Probably just a statistical fluctuation. The listings that came on that particular week just didn't exist for some reason. This is the holiday fluctuation, so I wouldn't make any news out of that, and I'd expect it to come back at 100%. Now, going back to demand, that's the red line down here, and you can see basically starting in week number 16 forward to up to present day, we've been below the level of demand you'd expect. 80%, probably 93%, down to about 85%, down to about 82%, and now at about 97%. And those are numbers I just made up, but looking at where the line is, it's pretty coarse. A lack of demand. So the demand isn't there any longer, and it's not fueling the economy. This I took a little note on. Look how flat that is. This is different data. This is based on 1 week data, macro, San Mateo County, Santa Clara County, single family homes and condos and townhouses. When I see all that, my first concern is, oh, my formula got broken. It's the same data. Well, I went back and looked at the raw data, and here's the data. So you're at 33.03 days, 33.15 days, and 33.09 days. And here's the math that got me there. The data is not locked. It is live data. It's just, again, one of those statistical fluctuations. And when you see how much sawtooth there is in this weekly data, to see it that flat for 3 weeks is pretty unusual, but it does happen. For 33 days is a very fast marketplace. Anything below 40, I consider to be a fast marketplace. Now we're comparing the number of new listings coming on the marketplace in the blue with the number of new offers. You can see for the most part, the blue has been above the orange. There's exceptions back here in 17, but for the most part, that's the one exception is 2015. If someone was to ask me what's going to happen, I would say we look very similar to this graph back here. So I'd look back to 2015 and say that's the marketplace that we're basically in. 15 wasn't a bad year. Remember, I said 15 through 19 were all 5 great years. We're still having a good year, although it's not going to be as insane as the last couple years. This is just the DUI. This is 5 weeks. So just pay attention a little bit. And that's why the data is a different number and a different shape. It's coming up because now it's going back instead of just 1 week, it's going back 5 weeks. I like using 5 weeks to understand the marketplace. 1 week gives you just too much statistical fluctuation, and you can't tell if it's a fluke or a data change. Lines that are drawn on here are basically 5 days per week. And when I saw this increase, you remember I basically was saying, wow, that's a warning. Is that the market shifting? And then again, we had a break, and then it came up again as steep, and then we had a break again. So it isn't a market shift, but it's paying attention. It's the time of the year you'd expect it to increase. If you'll notice, every one of these lines that's on here is the end of the year, except for pandemic, which was a pretty major impact. And you can see it was a bigger impact, steeper than the diagonal added in line. And so here it's something that caught my attention, but at this point in time, I'm not sure it's a huge issue, because if it was maintaining, we'd be way up here somewhere around 48 days of unsold inventory. We're only at 34, so we're not even in the same league. This is your days on market. This is something consumers understand. This is what a lot of people follow. So the orange line is your median days on market, and your blue line is your average days on the market. The reason I put it in there just because consumers are looking for it, but I don't follow it because look how stable it is. The market market has changed fairly significantly, but your days on market really hasn't changed. And the change in average was a statistical fluctuation just because we sold one house, I think it was, and I didn't pay attention. I should have. When I was doing the data calculations, sometimes I actually see raw data. I saw a property that was on there at 4,083 days on the market, and I should have flagged it. I'll go back and try to find out what the story was. It could have been just a data entry error, which is probably most likely because that's over 10 years on the marketplace for 1,000 days. I don't think it's a real data point, but when you're looking at large data like this, the large set gets rid of the one or two bad data points. So I didn't worry about it too much. So now what you're looking at is the sale price to list price ratio. The blue line is your average. So you can see it's been rolling down. Your orange line is the median. It's rolling down. Those are both red on the left-hand margin. And then the frequency of overbidding is also coming down a little bit, is red on the right-hand side. So we're still north of 85% of the sellers of all types of properties in San Mateo and Santa Clara County getting more than their asking price, but they're not getting as much above their asking price, and the market is definitely cooling a little bit. This is sale price. This is 10 percentile. So this is the cheapest, and this product doesn't exist because it's a blended product between condos and townhouses. This is the median that most people follow, and then this is the 90 percentile. So it gives you the range. But again, I normally don't do macro data. I started macro data with COVID. That brings us to any questions, and then I'll explain the URLs at the end. Does anyone have any questions for me? Not seeing any questions, I will move on. So now what we're looking at is available listing. The blue line is what's available right now, the total available inventory. We're basically just under 2,000. The yellow line is where you'd expect it to be. We're slightly above the level of. Where's it going to go? I think we're going to start seeing above average level of inventory. I would expect it to be above this yellow line going in 2022. Just to make it clear, the purple line is the separation between the 2 years. To the right is 2021, to the left is 2022, and I skip a week. So week 23 is actually week 22 of 2021. Same concept here, a number of new listings. You can see that the median normally dropped down last week because that's when the holiday was for my base years. And you can see it already came back up. So I would expect our inventory, the number of new listings to come on the marketplace, to increase next week. And again, this has been following the yellow line pretty carefully or closely. So that's what I'd expect. This is the number of new offers. And here you can start seeing this is where we were bouncing around and changing a little bit. But from this week on, which is week number 15 forward, we've been below the number of offers that you would expect to have. The market has clearly slowed. We're not even having the normal amount now. And again, I can't stress it enough. The normal amount is defined just because this was COVID related as the 5 years before COVID, which is 15 through 19, which were 5 great years. So I'm comparing to a great year. The fact that you're underperforming great years is not that bad. If I really had a more realistic average, we would probably be above whatever that number would be. This is days of unsold inventory in the 3 counties, and the 3 counties are red is Santa Clara County single family homes, the brown is San Mateo County single family homes, and the yellow is condos and townhouses in Santa Clara County. Oh, and I guess I should comment here. You can see the DUI. This is my benchmark of 5 days per week. And you can see we're clearly way below that, and we're starting to level off. And I would actually expect it to level off going forward, because remember, the 1 week was 33 days for the last 3 weeks. Now you're basically at 33 on the 5-week number. We know it's not really going to go much in either direction. This is a map showing the distribution. And then for those that have been following me for a while will know this is much paler pink than we've been used to, but still look at these days of unsold inventory. That's pretty aggressive. I consider 40 to 80 to be a balanced marketplace. I wouldn't expect price declines to really kick in till, somewhere around 70, 80 days of unsold inventory. It may this year happen whenever it does happen at a lower number, because the pressure, the amount of bidding and pricing was done because the market was so hot. So as that cools, that isn't really there. That's some of the froth of the marketplace, some of the overpaying of the marketplace. But anyway, you can see the market is clearly cooled dramatically just because the amount of white here has increased. In fact, that's a little surprising. But yeah, East San Jose, Central San Jose at 40, and 42.7, and there's no color starting at 42.5. So there's a hint of pink on there according to my computer, but I don't see it. And then Morgan Hill Gilroy is pretty white. The expensive areas in San Mateo County are pretty white, but just overall, you can just see the map is a lot less red. This is the overbid frequency. On the left is 2022. And you can see we're now down to about 82% of the sellers are getting more than their asking price. And this is back to 1 week data. You have to read my tops. Some of my data is 1 week, some of it's 5 weeks. Stuff that I'm trying to really read the market on, I try to do 5 weeks on. This is overbidding frequency. And I guess I better, now that I pointed that out, as label stuff, because I actually don't know if this is 5 week or 1 week. So I'll have to pay attention. I would assume this week. But again, it's the same three components: single family homes in Santa Clara County, brown is San Mateo County single family, and yellow are condos and townhouses. Very close together. You can see how much separation we had just the beginning part of the year, with condos doing the least, Santa Clara County doing the best. I would say they're basically all very equal at this point. Here is the frequency of overbidding. Now, the first thing that you should notice is the intensity of red on this map compared to the one we just saw a little earlier. Why is that? Well, to get the frequency of overbidding, I need sale price. So this data is 5 weeks ago. So 5 weeks ago, the market was much hotter than it is currently. The DUI is basically an instantaneous reading of the marketplace. So this is basically 5 weeks earlier than the data. And I would propose, if you went back to an old PowerPoint and compared the color of this map to the map 5 weeks ago for DUI, they'd be very similar. So this is a lagging indicator. This is the magnitude of overbidding over time. You can see how it's dropping down right now. Last year, just to refresh everybody's memory, that everybody thought was a real strong year, we thought the market was on fire and going crazy, was actually cooler than we are now. We're somewhere at 110% now, and we were about 108% last year. That's the concept that people need to understand. Even though the market has slowed down fairly significantly in the last couple of weeks, it's still a very robust marketplace. This is the three components over time. You can see they're all heading down. Condos tend to be a little bit more stable, but they've clearly rolled over at this point. Map of magnitude of overbidding, same as the previous slide. This is a much redder color than the initial DUI. And again, it's because I need the sale price. But I think Cupertino Sunnyvale is the high at 121%, and I think the low is at 104%. You can see the magnitude of overbidding in any micro market area is pretty incredible. This is the median sale price for the three areas. You can see that the condos, townhouses tend to be more stable. A little surprising to see this dip here. That typically doesn't happen, and it was actually a little bit after the New Year's, and you can see that, there wasn't a dip in New Year's in 2020. There wasn't a dip in New Year's 2021. And I typically say condos and townhouses are more stable pricing. So to see this is actually a little surprising for me. In Santa Clara County, you can see the significant rapid ramp up in price. It's not a straight line. It's not curving up. It's actually going the other way, almost exponentially accelerated. I actually believe it's a step function increase, and the public refuses to believe that. And so it comes up very rapidly. And then San Mateo County. San Mateo County, a little more bouncy because it's a smaller data set and higher pricing. Here's the map. Here, the middle number is the median. So for South County, the median price now is 1.4 million. The cheapest that you can find single family homes, and this is single family homes only, is $1 million. And the most expensive is 2.2 million. And by the most expensive, yes, there is going to be a few homes over 2.2 million, but that's the top 10 percentile. So there's only 10% of the homes above that price, and there's only 10% of the homes below $1 million. And you can see the least expensive areas at 950,000. We were getting close to the point where Santa Clara County and San Mateo County wouldn't have any single family homes under $1 million. This now is showing the individual micro market areas. The highlighted area is the record high or tied for the record high. So note that almost all the micro market areas have a record high price since May, because this is April 30th. So during the month of May. But if you assume it takes 5 weeks to close, that brings you back to the April timeframe, which is about when the market peaked. Here is the key recap of your different areas. Your DUI, you can now compare quickly how much lighter these shades are of red paired to the frequency and the magnitude. And if you look at the frequency and the magnitude, they don't match exactly, but they're very close. And on price, it's simply the white price, which is always Redwood City or has been, is white, and above Redwood City pricing goes pink and below goes blue. And you can see there's a lot of areas just slightly above, and then there's a fair number of areas significantly below. On condos, the most expensive is assigned white and the prices come down. I didn't want to use the same color scale for condos and townhouses. Here's some key components. We're looking at active inventory. We're now at 90% down from 94, which is still a shortage for Santa Clara County single family homes. You can see San Mateo County has a surplus, a 20% surplus. Santa Clara County condos has a 70% surplus compared to what you'd expect. And we've talked about the Bay Cities number actually not really being a good metric because of the building that's gone on. You can see all the DUIs are right in the low 30s with the exception of San Mateo condos at 27. The frequency of overbidding you can see is right basically at 88% except for Bay condos at 78%. Frequency of overbidding single family homes at 113%. Condos and townhouses close to 109%, call it. This is a little different here, so I'll slow down a little bit. This is my base year is the entire year of 2020. That has not changed. So these column over here labeled 2021 is the peak pricing in 2021. You can see you had basically 25% appreciation from the base year, the entire calendar year of 2020 to the peak of 2021. Now in 2022, that appreciation is 43% and 38%. That's still going back to the base year of 2020. If you wanted to get some sort of idea of what the annual appreciation is between the peak in 2021 and the peak in 2022, you'd subtract the two. So you'd get about 20% appreciation, 19% appreciation for Santa Clara County, and about 13% appreciation for San Mateo County. And this is the total overall appreciation. So this is to peak, and this is current. So you can see that Santa Clara County has peaked at 43%, is now down to 39. San Mateo peaked at 37.7, is basically flat at 37.5. That's how you read it. I thought that would be interesting to put in. And the increase for between these 2 years is not really exact because you're starting at 124%. So if you just did the subtraction, you're a quarter high, you're overestimating your appreciation by a quarter, but it gives you a ballpark. And if you divide it by 1.24, then you would get exact. This is a little bit more, and now we're adding in the different additional counties: Santa Clara County, Clara, Alameda County, Contra Costa County, and San Mateo County. And these are in order typically of what has the most volume. I'm going to leave them in this order. I also moved that this is all four combined if you wanted to look on. I'm not combining condos and townhouses. And on the condos and townhouses, I have the combined on the right hand. That just makes it easier for me to process the data. So you can see the number of new listings this week across the board is down from last week, and you can see the percentage that's down in green. That's because of the holiday, not because the market's changing dramatically or anything. The next group is the number of active listings. My definition of active listings is homes that are available without contract. A lot of people include what's pending, and that gives you some erroneous data. Then the number of new listings over all listings is here. I'm not sure that makes any sense, but it's a number I'm tracking since it's pretty easy to do for the time being. Number of offers accepted. You can see there really wasn't much of a change. Some went up, some went down. But again, you're in a holiday week, you expect some decrease. Where you'd expect the bigger decrease is next week because some of the consumers weren't available this weekend to look at open houses. Then DUI, here you can see in the different areas, overall 4%, 33%. And then in the different counties, since we talked about it earlier, this is 1 week data. So this is going to fluctuate fairly dramatically. The number of closings, average days on market, median days on market, over overbidding, median price, and appreciation. And this was noteworthy. 54% appreciation in Alameda County was absolutely the most. So clearly an affordability-driven marketplace. San Mateo, that had the most expensive homes, only saw a 25% appreciation. And again, that's over the entire 2020 calendar year, but 25% appreciation in essentially 2 years is really not bad. So we can't complain about that. This is not comparing apples and apples because this is essentially May data. May data is not available until June the 5th. We're not to June the 5th yet, but it gives you some idea. And I think some of the noteworthy things here are DUI, 32.7. If you look over that, you had years like 18, 17, even 15, where, and even 16. So there's a lot of years now here going back even to 2012. So 10 years worth of data. There's a lot of years where the DUI was a lower number. In fact, the only years where it was higher was the 2020, the pandemic year, and 2019. And I'm a little surprised to see 2019 there, but there it is. You're clearly having a slowing down of the marketplace. Again, even though it's a slowing of the marketplace, having 33 days of unsold inventory is a fast marketplace. Let's talk about volume for a little bit. We're 1,051. I expect this number will go up a little bit, but again, that's a pretty low number. The only number that's even close is the pandemic. Now, you're at 1,051. Can we get to 1,132? I'm not so sure. It's going to be tight because what you're doing is you're dropping off days in April, picking up days in May and June. So you'll pick up some days, but I'm not sure we're going to pick up close to 100 days. We may, it will be close. But again, you can see the volume is down. Number of closings are still pretty robust, and overbidding is pretty robust. This is comparing apples and apples, but it's looking in the rearview mirror because now you're looking at April data. Next month, I will only have one chart because the two will be very close together. And with that, I'll see if anyone's got questions after I explain the URLs. To get to this presentation live Saturday morning at 9 o'clock, you put in the root URL, which is shown in green, and then add in the 4-digit year 2022. If you want the handout, which has been posted about 15 minutes before the hour, you add the letter H 2022-05-28 to the root URL. To look at archives, you use the root URL, and to get to a specific one, you put in the 8-digit year, month, date code. So with that, do I have questions from anybody?
No, I don't have any questions. But it's a little thrilling.
You never know what to expect, that's for sure. Well, thanks for joining. Bye, everybody.